Hello and welcome to the recordings of the Advisory Group's workshop on what aging parents need to know. Thank you for watching these presentations. Let's first start with some introductions. My name is William Glenn. I am a Client Services Associate as one of the TAG team members. As speakers this morning, please allow me to introduce Brent Beverly, the President of the Advisory Group, Chris Lee, the Vice President of the Advisory Group, and Manny Chinche, an experienced Senior Wealth Advisor at the Advisory Group. All three of these gentlemen are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. While they are the wealth advisors of the advisory group, I know that they will agree with me that it is the TAG team members at the advisory group who make us shine. Please check us out and give us an opportunity to help you. At our firm, we partner with our clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with our clients any knowledge that can help you make an informed decision. We believe that the more you know, the more you will like what we do and how we do it. As a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. In this workshop, we'll primarily be focusing on retirement planning, which includes medical planning, and estate planning. Our discussion today is in 4 sections. These are the subjects we will be addressing in our recordings: taking Social Security, senior medical care, covering long-term care, estate, and legacy planning. There is a separate recording of each of these sections. Each of these sections could be their own extended presentation, so we'll be covering these with just a focus on the basics. Reach out to us if you feel that additional details would be helpful for you and your situation. Let's first start with Social Security. To get us rolling, please allow me to bring up our speaker, Manny Chinche. Manny?
Thank you, Will. When it comes to Social Security income, the major question for most people is when? When should I start taking benefits? Why do so many people collect benefits as soon as they can at a reduced amount? For many, it's because they have to. They need the income to meet their needs in retirement. However, many of those who don't have this necessity still elect to take benefits early. Why? They may worry about dying too young and forfeiting the money they paid into the program, but Social Security's calculations indicate for men and women who attain age 65 that life expectancy is 84 and 87 respectively. If you can afford to wait until full retirement age or beyond, you should take a closer look at your options. Claiming benefits at the soonest possible opportunity may not be in your best interest. You may want to wait until you're age 70 or sometime earlier that best fits your family situation. There are strategies you can use now that may help you maximize the benefits you will receive for the rest of your life, should you be fortunate enough to outlive your life expectancy. Social Security was never meant to replace 100% of our pre-retirement income. So how much does it replace? Now this varies, of course, depending on your earnings level and when you choose to retire. As an example, let's look at someone who starts their benefits at age 67. For anyone born after 1960, age 67 is your full retirement age or your FRA. If you were born before that year, you may be able to qualify at an earlier age. We will review that in more detail in a minute. So someone starting benefits at age 67 will find very low earners can expect their Social Security benefits to replace as much as 75% of their pre-retirement income. Medium earners can expect about 40% replacement, and high earners can only expect Social Security to replace approximately 27% of their pre-retirement income. Here we highlight 5 key risks in retirement and how Social Security can help mitigate those risks. Longevity. Social Security provides an income stream that a retiree or spouse cannot outlive. Inflation. Benefits are typically adjusted on an annual basis to account for cost of living increases. Markets. Benefits are not affected by the volatility of the markets. Taxes. For retirees at lower income levels, Social Security benefits may be tax-free. And even for the highest income households, 15% of benefits will be tax-free. That means that a maximum of 85% of benefits are subject to tax. Income. Social Security provides a regular guaranteed stream of income. This is especially important for retirees who do not have pensions. So let's review some of the fundamentals of Social Security. SSA.gov, the website, is a great resource, and we have that linked on our website. Eligibility. When you work and pay Social Security taxes, you earn credits towards Social Security benefits. The number of credits you need to get retirement benefits depends on when you were born. So if you were born in 1929 or later, you need 40 credits, which is equivalent to 10 years of work. Individual contributions. Through the Social Security payroll tax, which is currently 6.2%, workers fund Social Security. Note that employers also pay the same amount into the Social Security system, so the total is 12.4% of your salary. Now, payroll contributions top out once an employee reaches the maximum compensation subject to Social Security taxes each year, which is $147,000 in 2022. Benefits. Social Security benefits are based on your lifetime earnings. Your actual earnings are adjusted or indexed to account for changes in average wages since the year the earnings were received. Then Social Security calculates your average index monthly earnings during the 35 years in which you earn the most. We apply a formula to these earnings and arrive at your basic benefit or primary insurance amount, your PIA. Spousal benefits. Even if your spouse has never worked under Social Security, he or she may be able to get benefits if he or she is at least 62 years of age and you are receiving or eligible for retirement benefits. A spouse receives 1/2 of the retired worker's full benefit unless the spouse begins collecting benefits before full retirement age. If the spouse begins collecting benefits before full retirement age, the amount of the spouse's benefit is reduced permanently by percentage based on the number of months before he/she reaches full retirement age. Additionally, there are survivor benefits. Your widow or widower can receive reduced benefits as early as age 60, full benefits at full retirement age or older, or benefits as early as age 50 if he or she is disabled and their disability started before or within 7 years of your death. Is this complicated enough for everyone? We never said this would be easy. You'll hear this time and time again. Be sure to work with your advisor before making any final decisions on this. As you approach retirement, when to claim Social Security retirement benefits is one of the biggest financial decisions you'll need to make. Should you begin receiving benefits at your full retirement age, which ranges from 66 to 67, depending on your year of birth? Should you begin receiving a smaller monthly benefit before your full retirement age as early as age 62? Or should you wait past full retirement age to receive a larger monthly benefit? You can delay receiving benefits up to age 70 where benefits are maxed out. We have not yet found a reason to delay taking your Social Security benefits any later than your 70th birthday. As important as your decision is, there is no one-size-fits-all answer. It's a personal decision that must be made based on your unique circumstances. Of course, sometimes the answer is simple. You may have to claim Social Security benefits as early as possible if you need that income right away to meet your day-to-day living expenses, perhaps because of illness, disability, or unemployment. But if that's not the case, if you have other sources of retirement income or you want to continue working, for example, you'll want to take the time to make an informed, well-reasoned decision about your Social Security benefits. If you're like most people, you've paid into the Social Security system for years and you'd like to get the most out of it that you can. So to start, here are 2 major reasons why when you claim Social Security is so important. First, when you claim benefits can significantly affect your overall retirement income. With pensions disappearing, Social Security remains the major source of guaranteed lifetime retirement income for most Americans. Once you apply, your retirement benefit will be locked in for the remainder of your life in most circumstances, so taking time to explore your options now can help you have enough retirement income later. The timing of benefits can also affect your spouse because he or she may be entitled to receiving spousal benefits and survivor benefits based on the amount that you receive. So there's a lot to consider as you make this decision. And as we mentioned previously, here are some of the factors that this presentation will discuss. Your full retirement age and how your benefit is calculated. The amount of your future retirement benefit and the effect of taking benefits early or late. How many years you expect to spend in retirement based on your health and life expectancy. Whether you plan to continue working. Your other retirement income sources. Your income tax picture. And finally, how your decision will affect your spouse and the benefits that he or she may receive. Now, before we go into details, let's quickly go over two terms you'll need to know. The first term that we already mentioned is your full retirement age, your FRA. We'll tell you how to find this in a moment. The other term you'll hear a lot is primary insurance amount, your PIA. This is a calculation by the Social Security Administration that represents the amount you would receive monthly if you started taking benefits at FRA. Now, both of these terms are used as a starting point for calculating reductions or increases in benefits. Simply put, you'll receive 100% of your PIA if you file at FRA, but we'll get into that later. In order for the remaining slides of the presentation to make any sense, you'll need to remember these terms, FRA and PIA. So let's start with two basic things you need to know as you begin to explore your options. First, what is your full retirement age, that FRA that we've been mentioning? It's the age at which you can receive a full or unreduced Social Security retirement benefit. Your full retirement age ranges from 66 to 67, depending on the year you were born, as shown on this chart. To put this chart in perspective, people who were born in 1957 are turning age 65 this year. So check your birth year to see when you reach full retirement age. If you begin receiving benefits earlier than your full retirement age, you'll receive a reduced benefit. If you begin receiving benefits after this age, you'll receive a higher benefit because you will earn delayed retirement credits. Other benefits that you or your family members can receive are also based on what you're eligible to receive at your full retirement age. The second thing you'll want to understand is how your full retirement benefit is calculated. The benefit calculation is complicated and beyond the scope of this presentation, but here's a brief overview. Now, this chart on your screen shows the range of monthly benefits you may receive at different years. In our example, we assume your full retirement benefit at FRA of age 66 is $1,800. Depending on when you choose to begin receiving benefits, your income will change for the rest of your life. Your benefit is reduced by a certain percentage for each month you receive benefits earlier than FRA. So if your full retirement age is 66, this equates to a 25% benefit reduction at age 62. If your full retirement age is 67, this equates to a 30% reduction. However, if you delay receiving Social Security benefits, you'll receive delayed retirement credits that will permanently increase your benefit. Your benefit will increase for each month you delay receiving benefits, about 8% per year, past your full retirement age up until age 70. Note that we're only talking about benefits based on your own earnings record. In our hypothetical example here, if $1,800 is a full retirement benefit at age 66, the monthly benefit of $2,376 at age 70 is 76% more than the monthly benefit of $1,350 taken at age 62. That's a big increase. However, what this chart doesn't show is that you'll receive benefits for 8 years longer if you claim them at age 62 rather than age 70, and that can add up to a lot of money. In this example, if you receive a $1,350 benefit for 8 years, you would have received $129,600 by age 70. And this doesn't even include any cost of living adjustments. So we return to the fundamental question. Is it better to opt for a smaller monthly benefit at age 62, but receive it for a longer period of time? Or is it better to claim at age 70 to receive the highest monthly benefit possible? Again, there's no one-size-fits-all answer. In part, it depends on how long you can afford to delay receiving benefits and on how long you expect retirement to last. Being financial guys, we of course take the analytical approach to this question. When is your crossover point? Now this graph shows a hypothetical example of the points when the total benefits received when taken at a certain age break even with the totals received when taken at another age. As you can see, the later you take benefits, the greater the benefit amount will be when you get older. On the other hand, you'll have more benefits early in your retirement if you elect to take them early. How long you expect to live is one of the most prominent factors when deciding when to file. The Social Security Administration says that for an adult at age 65, the average life expectancy is 84 for men and 87 for women. On top of that, Social Security says 1 out of 4 65-year-olds will live past 90, and 1 out of 10 will live past 95. So remember, your lifespan may require a longer lasting income stream than you thought. It's important to consider this when deciding when to begin benefits. In this example, if you plan to live longer than age 82 and a half, you will bring in more money for the rest of your life by waiting until age 70 to take your Social Security benefit. Now, please note, to make this easier to view, this chart uses a hypothetical FRA of $1,000 per month. We want to point out that the ages would stay the same under these assumptions regardless of the actual FRA used. Of course, this is a hypothetical example. There are a lot of assumptions being used, so you would want to do this calculation based on your own conditions. Make sure your strategy reflects your unique situation. Now, to cover the next section, it's my privilege to bring up Chris Lee. Chris?
Thank you, Manny. I want to thank Manny and Will for getting us started. Let's continue looking at Social Security and what considerations you should be reviewing before making your final decision on when to take your Social Security income. In addition to the amounts that you can receive at different ages, there are several other factors to take into consideration when deciding when to begin your Social Security benefits. Some of these are your health or longevity, marital status, lifestyle expectations, other assets, and how many years you've been working. Remember to consider these and other aspects carefully because they're crucial and a crucial part of your retirement plan. That is the short version. Let's take a deeper look at how these factors might affect your decision. These strategies are much more significant to you now than they were to other generations. Why? Because longevity is a reality. It's important to the success of your retirement plan that you appreciate this factor. According to Social Security Administration's report, 1 out of every 4 adults 65 today will live past 90, and 1 in 10 will live past age 95. If you're married, you'll need to consider the joint life expectancies of you and your spouse, which will often differ from your individual life expectancies. I'm sure many of you are aware that medical advances and healthier lifestyles have increased longevity. Let's look at the bottom of this graph. A couple who reaches 65 has a 50% chance to living to their 90s and 25% chance to living into their late 90s. So we can assume from these statistics, one person from a couple will live into their 90s. However, many people are not taking longevity into account when taking their benefits. This chart will also be important when we discuss the need for long-term care in a few minutes. If you're thinking about working well into your 60s and 70s to increase your retirement savings, you may be wondering whether you can receive your Social Security benefit while you continue to work. The answer is yes. Many people choose to apply for Social Security benefits before they actually retire. But as you may have heard, earnings from your work may affect your Social Security benefit if you're under full retirement age. So, if you're under full retirement age and your earnings exceed a certain amount, called the annual earnings limit, part of your benefit will be withheld, reducing the amount you receive from Social Security. But once you reach full retirement age, you can work and collect full Social Security benefits. Earnings from the job won't impact your benefit at all. If you're under full retirement age, the rule is that $1 in benefits will be withheld for every $2 you earn over the annual earnings limit. This limit generally changes every year. In the year 2024, the limit is $22,320. In the year you reach full retirement age, a special rule applies. $1 in benefits will be withheld for every $3 you earn over the annual earning limit. This is a special limit. In 2024, this limit is $59,520. As mentioned earlier, at your full retirement age, earnings will not affect your benefit. However, to clear up a common misconception, you're not actually losing your benefits because you choose to work. So you don't need to try to limit your earnings. If some of your benefits are withheld, you'll receive a higher monthly benefit at full retirement age because the Social Security Administration will recalculate your benefit every year and give you credit for any of those earnings that were withheld. So the effect of working will have only a temporary effect, and any additional earnings you have will actually increase your benefit later. The Social Security Administration website has a tool called the Retirement Earnings Test Calculator that you can use to see how earnings before retirement might affect your benefit. For retirees with moderate or higher income, there's a good chance that at least some portion of their Social Security benefit will be included as taxable income. There are two different income thresholds for determining taxation of benefits. The income calculation, also known as combined income, includes your adjusted gross income, non-taxable interest income, and 1/2 of your Social Security benefit. And this will give you a figure that we call combined income. There on your screen, you see the levels that will be subject to taxation. For example, if that combined income total is $36,000 for a couple, we know that 50% of your Social Security benefit will be taxable. Now, to clear a common misconception, taxable is far different than taxed. People figure 50% of their Social Security will go to taxes, which is not the case. 50% of Social Security would be subject to taxes at whatever your rate ends up being. The other 50% is tax-free. If you're married, there's another important question you need to ask before you decide when to claim benefits. How will my decision affect my spouse? That's because when you begin receiving your retirement benefit can dramatically affect your spouse's benefit during retirement, and thus your household income. Your decision can also affect any survivor benefit your spouse may be entitled to. And your spouse has decisions to make too. Together, you'll need to consider what the most appropriate combination of claiming ages is based on your ages, earnings, and life expectancies. Other people, such as your dependent children or a former spouse may also be eligible for benefits based on your earnings record. But the rules are a bit different and they're not covered in this presentation. There are many complexities associated with these benefits, so it's necessary to plan properly. Here are a few general points to consider about spousal benefits. If you file for spousal benefits at full retirement age, spousal benefit will be equal to 50% of your spouse's PIA. You must be 62 or older to qualify. You cannot collect benefits on current spouse's record until he or she files for their own benefit. Amount is reduced if taken before full retirement age, but won't increase if delayed. These rules also apply for divorced spouse benefits. As long as the marriage lasted at least 10 years and the beneficiary spouse is currently unmarried. In addition to retirement benefits and spousal benefits, married couples must consider survivor benefits. When you claim your Social Security benefit can greatly affect the amount of income available to your spouse should you die, because your surviving spouse will generally receive the benefit that you were receiving at the time of your death, unless your spouse is already receiving a higher benefit based on his or her own earnings record. If your spouse's life expectancy is much longer than yours, this can be especially important as a consideration. Survivor benefits may be payable as early as age 60. However, a benefit reduction will apply if the surviving spouse begins collecting a survivor's benefit between age 60 and his or her full retirement age. Here on your screen is a hypothetical example that illustrates why it's important for spouses to carefully choose when to begin receiving Social Security retirement benefits. In this example, both spouses are able to claim benefits based on their own records. Spousal benefits are not considered. As this table shows, if both spouses choose to claim benefits at age 62, their joint monthly income will be $2,784. But if both spouses wait until age 70, their joint monthly income will increase to $5,241, a difference of $2,457 per month. That's almost $30,000 a year. In addition, by waiting longer to claim retirement benefits, spouse 1 may also substantially increase spouse 2's monthly survivor benefit, since Social Security generally pays the surviving spouse the larger retirement benefit. Of course, this illustration does not take into account the other factors that this hypothetical couple might need to consider, and your own situation and overall income plan will be unique. There are some other concerns regarding Social Security. To review that, please allow me to bring up Mr. Beverly. Brent?
All right, thank you, Chris. I appreciate it. So as the Marine of the group here, they like for me to carry the difficult questions here. So when we talk about Social Security, one of the questions that seems to be on everyone's mind, and certainly on our mind, is will Social Security be there when I need it? There's a lot of information out there today telling you that the system is insolvent, it's broken, or even worse. Though most of it would probably agree that the concerns about the program's sustainability are legitimate, the controversy has created some misconceptions. We want to talk about those. Now, each year, we send out a summary of the Social Security Trustees Report. And it's a good idea to take a quick look at some of the information from the program's trustees who publish an exhaustive report every year. If you haven't read our summary, we recommend doing so. We've also posted the trustee report on our website. In addition to the summary, you do some reading, check it out. Now here are some of the report's findings. So according to the 2024 Social Security report, the year 2023 was pretty much a typical year for Social Security. Low unemployment leads to more funds coming into the program and fewer funds going out. So when we look at this, you see the income, $1.35 trillion. Now that includes $67 billion in interest, and we'll talk about that here in a minute. The expenses were a little bit higher, $1.39 trillion. Now there was still $2.7 trillion of balance in the OASDI, the trust fund that supports Social Security. So that's where the $67 billion of interest came from. Now, 67 million people are receiving benefits, with 183 million people contributing into Social Security. 2020 was a crossover point where expenses in the program, primarily benefit payments, began to exceed the income generated from contributions and that interest. 2020 was the first time that the expenses exceeded the incomes. Unchecked, this will lead to the program becoming insolvent in 2033. Now, an important note, this does not mean that Social Security will end, but it does mean that the benefits are likely to be seriously reduced. The current projection is that the benefits would be reduced 23% across the board in the year 2033. Now, we've seen figures that indicate the income benefit reduction of somewhere between 20 and 25% occurring anytime between 2032 and 2035. It seems to change each year and who's looking at the numbers, but it seems pretty consistent there. So if the difference is made up from the reserves of the disability fund, another fund which is sitting out there, the combined reserves are expected to be depleted in 2035. So roughly 10 years down the road, expecting a major change in Social Security. Now, this projected insolvency of Social Security is not something new. The program was historically set up as a pay-as-you-go system that was not entirely feasible with the changing economics and demographic trends that have occurred in our country. In the 1970s, the Social Security Board of Trustees predicted short-term and long-term financial problems for the system. Let's look at some of the things that the Social Security Administration and the federal government can do to help solve this problem. First one is they can increase the Social Security tax rates, i.e. how much they're charging each person. They can do a higher maximum of earnings subject to Social Security tax. Now this is already up to $168,600, but they could raise that up or have it like they did for the Medicare tax and make it unlimited. So any earnings, any work earnings that you have can be taxed for Social Security. They can increase the full retirement age, which they've already done. They can do it again. They can decrease future benefits across the board or for select people. They can reduce future cost of living adjustments, what are called the COLAs, cost of living adjustments. Now, we've already figured in our planning and our experience is that the increases that Social Security gets now is already somewhat less than the inflation rate for retirees. In other words, the increase in benefits we're getting now don't really keep up with the cost of living that retirees face. But they could do that even more. They've already done it once, they can do it again. Congress addressed these issues previously with the passage of the 1977 amendments. We talked a little bit about that. This included provisions to increase the tax rate, increasing the earnings base, as well as reconfiguring the benefit formula. But it was not enough. And by the early 1980s, Social Security again faced this similar serious financing crisis. Now, a law passed in 1983 made numerous additional changes, including the taxation of benefits, raising the retirement age, increasing the reserves in the trust fund. Now, with the passing of the 1983 amendments, the financing problems of the late 70s and early 80s were temporarily resolved and pushed out to where we are now with the mid-2030s. We can only hope that somewhere in the near future, our politicians can get their act together and do that again. Now, this presentation has explored some of the major questions that you'll want to consider as you decide when to begin receiving your Social Security benefits. Let's do a quick recap. Here are some of the reasons you may decide to claim benefits earlier. You expect a shorter lifetime for you and your spouse. You need Social Security income right away. You may want to invest your monthly benefit. You may want to delay having to take funds from other vehicles. Or your spouse wants to delay claiming benefits and it works out better for you. Or from our recent discussion here, you think your Social Security benefits will be reduced if you wait. Now, other people decide to claim benefits later. You may want to wait on doing that if you want the higher monthly income throughout your retirement. You may want to maximize the survivor income. You may plan to work longer. And you may be able to file for spousal benefits first, then switch to your own benefit later. Remember, the choice is yours, and it's up to you. And with our guidance made based on your unique needs and circumstances, it depends what you want to do. Okay? Retirement can be an exciting time, but it comes with challenges, and so on. Now, we've covered a lot of the Social Security information here. So what should you do? As a starting point, if you haven't done it already, we urge you to go onto the Social Security website. We have a link in our TAG website under Resources, TAG Web Resources. The Social Security website will provide you with a couple of relative easy ways to estimate what your retirement benefits you might receive. Now, first, you need to sign up to access your Social Security statement online so that you can view your actual earnings records and what you expect to receive under the current law. If you apply at age 62, at full retirement age, at age 70. If you're already age 60, you'll also have the option of receiving this statement in the mail every year, about 3 months before your birthday. Now, an important note, be sure to check your actual earnings record to make sure that what they say is what you say is your accurate earnings information. I reckon, it's usually easier to get this done sooner rather than later. We recommend that everyone check their Social Security record regularly to make sure that the reporting of your incomes are correct. The second way to estimate your Social Security benefit is to use the Social Security Administration's retirement estimator, which is also available on that website. Now, this calculator allows you to input various scenarios based on current law to estimate your future benefits. As you near age 62, you should also contact the Social Security Administration to discuss your options. Representatives are not allowed to give you advice about when to start your benefit, but they're happy to explain your options and the rules that might apply. And when it comes time to apply for your Social Security benefits, you can do that online, by phone, or in person. Now, as a side note, the Social Security Administration is pretty backed up, so you should reach out months in advance of your expected benefit date. Expect at least part of your discussion to be completed by phone or online before you meet with a live person. Now, of course, we have important disclosures from today's meeting. I hope you have time to read these. If not, pause and you can go through these. We want to thank you for attending today. We hope you enjoyed gaining new knowledge, and we're thankful for the opportunity to assist you with your financial needs. So remember, at our firm, clients always come first, and your health and well-being is our highest priority. And we believe that you'll find the knowledge that you've gained today to be helpful for you and your family. Now, if you have any questions or would like to be added to our distribution list for up-to-date information, please reach out to us. We're glad to be of service. Now this concludes our presentation, but remember we have 3 other presentations from this same session that we recommend that you listen to the other 3 as well. So thank you again. Always our pleasure. Have a wonderful day.